In yesterday's forecast, we explored the astrology, numerology, earnings calendar, and market structure for January 20th, 2026. The model suggested a post-holiday reopening session with early optimism, intraday volatility, and sector rotation. Instead, the markets delivered something very different, a full-scale risk-off liquidation. The Dow Jones Industrial Average closed at 48,488.59, down 870 points, or 1.76%. The S&P 500 closed at 6,796.86, down 2.06%. The NASDAQ closed at 22,954.32, down 2.39%. At the same time, precious metals exploded higher. Gold surged to $4,762, up more than 3.6%. Silver jumped over 6%. Platinum also gained more than 6%. Only copper slipped slightly, down about 0.25%. This was not a rotation day. This was a broad, fear-driven repricing event. So what changed? The key factor was a late-stage geopolitical shock. During the session, markets reacted to confirmation and escalation of proposed U.S. tariffs on 8 European countries, tied to the Greenland dispute. That single development triggered immediate global risk aversion. When trade relationships, NATO alliances, and global supply chains suddenly look unstable, institutional investors don't rotate. They de-risk. That means selling equities and buying safe haven assets. That is exactly what we saw yesterday. This kind of macro-political shock overrides normal timing models. Astrology and numerology can show sentiment conditions, confidence levels, and susceptibility to news shocks. But they cannot always forecast the magnitude or timing of external policy decisions. In market terms, an exogenous event entered the system after the forecast assumptions were set. Interestingly, the astrological setup did show the correct mechanism. Mercury and Neptune, both at a critical degree, did in fact correlate with destabilizing headlines, sudden narrative shifts, and loss of confidence in messaging. The model interpreted this as information fog and choppy trading. The market expressed it instead as a decisive fear reaction. The mechanism was right. The directional interpretation needed the geopolitical catalyst to be known in advance, which of course we didn't know until after that video was already made. The metals forecast actually held directionally. Gold and silver were expected to rise on uncertainty, and they did, just far more aggressively than projected. Copper was expected to soften slightly on growth concerns, and it did. Platinum was expected to show Uranus-style breakout strength, and it delivered. The scale was larger than anticipated, but the directional logic remained intact. This is an important reminder that markets are probabilistic, not deterministic. No model, technical, fundamental, quantitative, or astro-numerological, can fully anticipate sudden policy shocks. What matters is understanding why the model missed and whether the underlying sentiment signals still made sense. In this case, they did, but the external catalyst overwhelmed the baseline scenario. So what's the takeaway? The market prediction for January 20th, 2026 was not a failure of pattern analysis. It was a reminder that geopolitical risk is a dominant force when it appears suddenly. The forecast assumed a normal reopening session. The world delivered a trade war escalation instead, and markets responded exactly as they always do in that situation. Sell risk, buy safety. This is exactly why we do post-market reality checks. Forecasting is not about being right every time. It is about refining assumptions, understanding drivers, and tracking how sentiment reacts when unexpected events occur. If you appreciate this kind of transparent follow-up, where we review what happened, why it happened, and what we learned from it, please like the video and subscribe. Before we wrap up, a quick reminder. This content is for educational and entertainment purposes only. I am not a financial advisor, and nothing here should be considered financial advice. Always do your own research and consult a licensed financial professional before making investment decisions. Astrology and numerology are timing and sentiment tools, not guarantees, and markets will always have the final word.